Today I'm going to explain impound accounts, what they are and why you might want one. An impound account, sometimes referred to as escrows or an escrow account, is basically a separate account that's set up with your mortgage where a portion of your monthly payment goes toward property taxes and homeowners insurance. So instead of you paying those bills directly, the lender collects a little bit each month and then pays them on your behalf when they are due. When you think about your monthly payment, there are a few pieces that can be involved. Principal and interest, your actual loan payment, property taxes, homeowners insurance, also known as hazard insurance, and if you have a condo or a PUD, you may have HOA dues, although we'll leave those out of this explanation. In California, property tax bills are typically due twice a year. Hazard insurance premiums are typically renewed annually. So an impound account is designed to do a few things. Make the cost predictable and manageable by spreading it out monthly. Reducing the risk of missed payments, which can lead to tax penalties or even an insurance lapse. And from the lender's perspective, it helps protect the property because if taxes aren't paid or insurance isn't active, it creates a bigger problem for everyone involved. Instead of you having to remember, okay, taxes are due here, insurance renews there, let me make sure I've set aside enough to cover those. An impound account is basically the system that says we'll collect it monthly and handle the timing for you. Here's a really important point. The impound portion of your payment isn't fixed forever. It's based on estimates and real bills. So once a year, the lender does what's called an impound analysis. They look at what your tax bill actually was, what your insurance premium actually was, whether the account ended up short or overfunded. If taxes or insurance go up, your impound payment will adjust. That's why some homeowners see their total payment change even if they have a fixed rate mortgage. The loan payment didn't change, the taxes and/or insurance portion did. It's important to note that when your property taxes or hazard insurance change, your overall cost will change regardless of whether you have an impound account or not. So why would you want an impound account? Budgeting and predictability. An impound account keeps things simple with one monthly payment covering all three items. Convenience, you're not tracking multiple due dates or stressing about a lump sum bill hitting at the wrong time. Fewer oops moments. Missing insurance or taxes can create real consequences. Impound accounts reduce that risk. Now for the cons. Less control over your cash flow. That money is being collected and held. You can't decide when to move it, when to invest it, or how to time it because it's earmarked for taxes and insurance. Not ideal for certain income types like commission or bonus. This is a big one. If you're paid through commission, bonuses, RSUs, or irregular income, you might prefer to manage money differently. Some people like to keep their monthly obligations lower, then pay taxes and insurance from larger income months. For these homeowners, impound accounts can feel restrictive because it forces a steady monthly structure that doesn't match how their income actually arrives. So an impound account isn't good or bad, it's a tool. The right choice depends on how you budget and how you're paid. If you like predictability, fewer moving parts, and you don't want big bills sneaking up on you, impounds are usually a win. If you're organized, want maximum control, and you'd rather manage large bills strategically, waiving impounds might be a better option. And yes, sometimes depending on the loan type and down payment, the lender may require you to have an impound account. I hope that helps. If you have specific questions or want to discuss your particular scenario in more detail, please reach out. I'm here to help.